Welcome everyone back to the Noob Selling Options channel. Today, we're going to break down a pretty wild situation I found myself in recently. We're going to look at two very different trades that I used to manage one single position during a massive, and I mean massive, stock rally.
All right, so let's set the stage. When a stock you're trading just takes off like a rocket, it can really test your nerves, right? It can feel like you're just hanging on for dear life. But this is where active management becomes so crucial. It's about grabbing the steering wheel and saying, okay, how can I use this? We're going to play offense on one side and some serious defense on the other.
So, first up, let's talk about the fun part, the offensive move. This is where I looked at the stock's insane strength, and instead of seeing it as a problem, I saw it as a golden opportunity, a chance to get aggressive and really capitalize on all that momentum.
Okay, so here's exactly what I did. You can see the mechanics here. I bought back my old short put, that was at the 450 strike, and at the exact same time, I sold a brand new one. But check this out, I moved it up a whopping 80 points, all the way to the 530 strike, for the same July expiration. A huge adjustment.
And what's the result of that move? Well, here's the best part. This single roll brought in an extra $939 in cash in premium per contract. Think about that. The market literally paid me almost $1,000 to adjust my position and take on a level of risk I was already perfectly fine with. I'll take that trade any day of the week.
So there's actually a term for what I did here. It's called an aggressive roll-up. And it makes total sense, right? Because the stock had just skyrocketed. My old 450 put was so far out of the money, it was basically worthless. The premium had just vanished. So by rolling the strike up, I was actively chasing the stock's new price, trying to get back in the game and generate some real income again.
Now, what was going on in my head when I made this trade? It really boiled down to two things. First, capital efficiency. That old 450 put was just dead money. It was tying up a bunch of my margin but wasn't doing anything for me. It was lazy capital. And second, this was a statement of high conviction. By moving up to 530, I was basically saying, yeah, I'm confident this stock is going to stay above this new, much higher level.
You could absolutely call this greed, and you know what? It kinda is, but in a good way. It's what I like to call intelligent greed. It's recognizing that your money isn't working as hard as it could be, and then actively taking a step to put it to better, more profitable use.
So to wrap up the put side, this was all about being opportunistic. It was about seeing overwhelming strength and leaning into it, not running away from it. The goal was simple: grab more premium, put my capital to work more efficiently, and basically just play pure, unadulterated offense.
Okay, now, let's flip the script completely. Let's talk about the other side of this position, the call side, because here the story was the total opposite. That same incredible rally that created this great opportunity for my puts, well, it was a direct 5-alarm threat to my short call. This was not the time for offense. This was time for defense, pure and simple.
The action here looks pretty similar on paper, right? I bought back my short call at the 1400 strike, and then I sold a new one. But instead of moving it closer, I moved it further away from the stock price, up to the 1470 strike.
And here is the critical difference. This move cost me money. A lot of it. You can see it right there. It was a net debit of over $1,400. I had to pay to make this adjustment. I willingly opened my wallet and gave back some of the money I'd already made.
So why on earth would I do that? Well, this is a classic defensive roll. And you have to remember, with a short call, especially a naked one, your risk is, well, it's theoretically unlimited. If the stock just keeps going up, your losses can be astronomical. The rally was getting dangerously close to my 1400 strike, and I had to respect that momentum. I had to give myself some breathing room.
The psychology here is something every option seller has to grapple with. It's a trade-off. You accept the definite, short-term pain of paying that debit to avoid the potential for a catastrophic account-blowing loss. I wasn't just buying 70 points of extra space for the stock to run. I was literally buying peace of mind. I was buying the ability to sleep at night.
Look, it's never fun to pay to adjust a trade that's going against you. It stings. But this is a perfect example of choosing survival over ego. Your ego tells you, nah, it'll turn around, just wait. But experience and good risk management tells you to protect yourself now. Your long-term success as a trader is built on these kinds of tough, ego-swallowing decisions.
So the key takeaway on the call side, it was all about risk mitigation, respecting the trend, defending against that unlimited risk, and buying myself an extra 70 points of headroom. Ultimately, it was about buying the time and the space I needed for my long-term thesis on this position to hopefully play out.
Okay,
So let's zoom out. We have these two totally different trades, right? One was aggressive, almost greedy. The other was defensive and cost me money. So how in the world do these two pieces fit together? How does this become one single, coherent strategy?
It's because they are two sides of the same coin. The coin is called managing a dynamic short strangle. When you're trading a stock with this kind of momentum, you absolutely cannot just set your trade and forget about it. You have to be active. You have to be dynamic.
And this is where it all comes together. It's a two-pronged approach. I played offense with my puts, using the stock's strength to aggressively collect more cash, and then I took some of that cash and used it to fund my defense on the call side. The aggressive move literally paid for the defensive one. It's a beautiful thing when it works out like that.
And what did all of this accomplish, really? Well, by rolling both the put and the call up, I was basically picking up my entire profitability corridor, that price range where I can make money, and shifting it higher to match the stock's new reality. I was moving the goalposts to stay in the game.
So these adjustments have basically reset the entire position. It's got a new lease on life. But that doesn't mean the work is done. It immediately brings up the next big question: what do I do from here?
And that brings us to the big question now. What's the game plan going forward? Do I just hold these new positions and let time do its thing, hoping they expire worthless? Or do I set a specific profit target and get out early if I hit it? It's that classic trader's dilemma, right? Patience versus taking a quick win. I'd actually love to hear what you guys think. What would you do in this situation? Drop a comment down below. And hey, if you found this breakdown helpful, do me a huge favor and hit that like button and subscribe for more deep dives like this one. Thanks for watching.